everyone. Thank you for joining us today. Uh, we are, no, we, this is Ayushi, and I am the Associate Sales and CRM at WhiteCoats. We are hosting a talk on the importance of financial planning and inflation for doctors. Today we have on our panelists Mr. Pratik Trivedi and Mr. Rachit Bakshi. So without further ado, I'll start by a brief introduction of WhiteCoats. So WhiteCoats is India's largest 360-degree professional platform, success platform for doctors. WhiteCoats offers personalized growth services, community of 3 lakh plus doctors, professional opportunities, knowledge articles, clinical cases, and more. We are best in class technology products. Why WhiteCoats? We work as a partner for your professional success. We help you grow your practice under your own brand name. We are trusted by thousands of customers globally for doing business with integrity for over 20 years now. About Sapient. So, Sapient is the most admired and respected wealth management firm, bringing financial independence and abundance to their clients. They are in the business of simplifying your investment journey. Sapient keep various communication channels open and listen intently to bring clarity from a position of empathy, ensuring security and delivering prosperity to the clients to help fulfill the needs and achieve the aspirations. Sapient is also a 6 times winner of CNBC TV 18 awards for best performing independent financial advisor and have received many other records as well. It has about 200 employees pan India in 7 offices. Sapient is managing asset of about 9 billion. Talking about our panelists today, Mr. Pratik Trivedi, he is the associate partner at Sapient Wealth. He is our SPOC, and it was his idea for this interactive and helpful session, as this is our second session in collab with Sapient after our first successful one. So, about Mr. Rachit Bakshi. Rachit is a senior financial services professional with about 17 years of experience, having worked in leading asset management companies and multinational banks. He is Senior Vice President, Sales at Sapient Wealth. His core areas of expertise are business management, wealth management, key account management, sales, relationship management, channel management. Just a little housekeeping before we get started. If you have any questions during the presentation, please type them into the question box. I'll bring them during the presentation and we will have time for our Q&A session. Thank you, Rachit and Pratik. We will go ahead now. Over to you.
Thank you so much, Ayushi, for the introduction. And also thank you very much for the opportunity given to us to interact with the doctors. And first and foremost, I would like to thank each and every doctor here for your service during the COVID times. A very noble thing, very noble profession, and I think along with me, the entire country is thankful to you. Today's topic on inflation for doctors and financial planning, it is a topic which is relevant to each and every individual who wants to invest and let the money grow. We all work hard, very hard for our money, but our money should work harder for us. So, in the next 1 hour which you spend with us, I can assure you that many of your doubts will get cleared. And in case there are still few more doubts which are yet not covered, we are more than happy. You can reach out to us and we are more than happy to assist and ensure that your doubts are cleared and your journey in the world of finance is made smooth by us. Ayushi, so can I take over the screen, please? Can I go ahead and share my screen?
Yeah, Rachit, I have stopped sharing my screen. You can take it over from me.
Sure. Okay, are you able to see an Excel calculator here?
Yes,
Yes,
that's right.
Rachit. Yeah.
Okay. So basically, before I get into the presentation, I just wanted everybody to take a glance at this. This is a very, very useful financial calculator, which we are going to run at the end of the presentation. This, helps you to plan your finances. This helps you to, estimate each and every, expense which you are going to have an incur. As a thank you gesture from Sapient, we are more than happy to share this calculator with everybody. At the end of the session, we are going to demonstrate this, and and then it will be available from our end for your use. And trust me, this is one of the best tools which you can have made at Sapient. So without further delay, I am getting into the presentation. Just give me a minute, please. Yeah, please let me know if my screen is up and you're able to see it.
Yes, Rachit, definitely.
Yeah, okay. Okay, so the first part, like in the medical world, you have this terminology called health check. We have a terminology in our financial world called as wealth check. What exactly is wealth checkup? It is nothing but everything which is needed for you to know that where do you stand, what assets you have, what expenses you have, and how do you need to plan those expenses. So first, expense, which is your daily requirement. You may have your daily costs, which you need to be careful about. Second is your monthly and yearly budgets. So, like any individual, you may have your monthly spendings, which are, are fixed, yearly budgets, which you may want to have it planned. Then comes your immediate short-term and long-term planning. Now, how do you classify this? A short-term goal could be that, you would want to say, in the world of medical, doctors study and attend a lot of higher, get into higher courses and keep on upgrading their skill. That could be a short-term goal. A long-term planning could be your own clinic, your own hospital, or, having your practices across the states or in different parts of the world. So that's long-term planning. In this, there is a children education, marriage of your kids, insurance, mediclaim, term plan, everything to do with finances. Business or professional, here I mean to say that how do you scale your business, or how do you scale your practice? I think practice is the right word here. That if you would like to have a plan in place that after 10 years you would like to have your own practice or have multiple clinics or have desires to open different hospital, how do you scale? How do you need to plan? So that is something which we are going to cover in this presentation, and what is the correct approach to follow the plan. And last is that to reach this goal, how do you need to invest and where do you need to invest? So this is the wealth checkup for us. Very similar to your health checkup. Health checkup is everything to ensure that you are in the right state of health. Same way, these all components are very important for you to keep a check on, to ensure that you are at the right, you are well covered in the world of finances. You are well covered, and you always have the adequate money to execute the goal which you have been waiting for. Moving on, this is a typical problem which we need to highlight to the medical professionals. Unlike any other profession, a medical profession is a profession where the earning phase or the startup phase is pretty long. In the world of finance or anybody joining a telecom industry or any industry. So, let's take an example of MBA, Master of Business Administration. Typically, an MBA can pass out at the age of 23, 24. A chartered accountant, again, gets his certificate of practice by 23, 24, and by 25, he is up and running. But the problem of medical profession is that the startup phase is pretty late. And because of this, you are losing out on valuable years in the earlier you're losing out approximately 7 to 10 valuable years, where because you are not investing, or because you may not have adequate money to invest, you're losing out on something which we call cost of delay. I'm going to demonstrate what is cost of delay and how does it pinch you hard, and how do you need to ensure that once you are in your peak earnings, you invest adequately, you invest the right sums, so that you are able to achieve your goals at the right time or before. So few problems which we identify for our clients to show to them that where are you better off, or where are you at a where are you at a disadvantage, so that how do you plug this gap. Now, coming to the financial mistakes by doctors. Now, this is in our experience. I have close to 17 years of experience of advising clients on their different financial goals and need. We have listed here few financial mistakes which the doctors make. Doesn't mean that the ones listed here are your mistakes, but what happens is sometimes a particular professional goes overboard into them. One of the number one reasons, one of the number one mistakes here is over concentration in real estate. What happens is, whenever a doctor has a good sum of money, they largely invest into real estate, and that's been the trend of our country, that real estate has always been seen as the number one destination for any investor. The problem is an over concentration into real estate. So I'm not saying one should not invest, one should, but an over concentration is really a big problem, because real estate investments are very, very illiquid in nature. They have not been the greatest return generators. The highest return generators in India has been equities. So a right allocation to real estate is needed, and over concentration can actually be in the negative interest of the investor, where it drags down the return on the portfolio quite significantly. Second is inadequate and improper insurance. The other thing what we have cited is that a lot of the clients here have heavy dependence on an LIC or something, where they are looking at they are looking at as an insurance from an investment point of view. Insurance is not to be seen from an investment point of view. It is to cover any uncertainties in case, God forbid, something has to happen to you. Your family members are taken care of it. Either we have seen that there is a lot of inadequate insurance, or there is no seriousness towards insurance. And whatever I'm saying here is from a financial planner point of view. Investment without planning. Now, this is again a big problem. Let's take an example. Somebody got a lumpy flow of money. They would want to invest it, but they would just park the money into FDs, not invest into equities, not invest into instruments which have a higher potential to generate returns. Because whatever I'm stating here, I'm going to show in the later slides that when you do not invest properly, or you do not invest into the right instrument, what kind of a opportunity loss you incur over a longer period of time. And trust me, friends, the opportunity loss is extremely big. It's extremely big, which I will show you in the later slides. There is doctors tend to take a very myopic view for tax planning. Basically, one of the reasons here also, and the linkage to here, is that, a lot of doctors are very comfortable and happy with cash income. The problem with the cash income is that it cannot be deployed into financial instruments. All the financial instruments have to be routed through your bank accounts. If you do not do that, your access to financial instruments is not available. So one very, very strong advice here is that one needs to ensure that the tax planning, or the kind of income which they are generating, needs to be routed through the bank account, because that is only when you get access to instruments which are higher generating in nature. And that's a very, very important point which I want to leave back with everybody here. Since I was just talking about insurance, I just want to give a disclaimer here. We at Sapient do not advise any policies on insurance, but since it's a part of financial planning, we definitely want our doctors to know that insurance is definitely not an investment vehicle. It is only and only to cover you from any uncertainties. The best product on the insurance side is a term plan. You need to have a very good term plan, a term plan which is in excess of 1 crore, 2 crore. In case God forbid something has to happen to you, that money would go on to your dependents, and their life would carry on the way it should be. So since it's a presentation highlighted on the merits of financial planning, it was very important from our side to highlight this point, that insurance, people use it to save tax, investment, guaranteed return. All three vehicles are not the right way to look at it. In our view, insurance is a risk coverage. That's it, nothing more. It's a cost. It's not an investment. It's a cost which one needs to pay to ensure that our loved ones are taken care of in case something were to happen to us. Now, let's look at the important part, that, why do we invest, or why do we need to invest? One single most reason is to, beat the inflation. And, why do we talk about inflation in the financial world? Inflation is nothing but, the price at the percentage at which your commodity or the thing gets, expensive year on year. Let's take a very simple example of the three items here, which were at X cost in the year 2000 and what they are today. Let's take a cost of one piece of egg. In the year 2000, it was worth 2 rupees, and now it is in 2021, it is costing 7 rupees. So it's been an inflation of 6% for the egg. Amul milk, 1 liter, 18 rupees, and today it's available at 46 rupees, a 5% inflation. This 5% is a CAGR, compounded annual. And today 1 kilo of these chana is 30 rupees, now it's 140 rupees. So inflation is something which we do not have a control on. It will keep on making the commodities expensive. How do you beat the inflation? Very simple answer: invest into instruments which can give you a rate of return which is higher than inflation. So if your inflation is 6%, ideally we say that for a country like India, 6% is a good inflation number to keep in mind. Your instrument should be able to deliver returns which are more than 6%. Very simply speaking, I'll talk more about it in the later slides with certain examples also. Now, this is what we showed you, that what has happened in the past. Now, let's look at an example with that what is going to happen later. No, this is what one should look at. Say that today's price of these three commodities are 40, 235, 180. What is the price which is it going to be at 2031? This is the estimated price. Give it or take away 5-10 rupees, but this is the price where it will reach. And very realistically, it will reach there, because I have already showed you an example when in the last 21 years, what's been the inflation for those products. Same inflation at the rate of 6% has been applied here. And this is how it will reach here. So what do you need to do? You need to, again, invest into products, invest into the instruments available out there, which has the capacity to beat the inflation. Else, what will happen is either you will invest into instruments which are not beating the inflation, or so you are degrowing your money. You will struggle to actually buy these products, or if you are just about beating the inflation, you will not be able to take care of your goals. That is the unfortunate part. So again, takeaway here is invest into instruments which beat the inflation. Now, I showed you examples of few of the commodities which are available. Now let's look at the medical inflation. I think you all being doctors, you will be able to relate to this better. That a blood test, for example, which was 2,500 rupees, after 15 years it will grow to 11,000 rupees. Yes, after 20 years 20,000, and 30 years 57,000. Here we have put an inflation of 11%, because in our study or in our data we have seen that inflation for a medical grows much faster or at a much higher rate. Of course, what may also happen is that few of the tests after 20 years probably may be a replacement, because the kind of medical research advancements they are happening, may make these tests outdated. But again, the point I'm trying to make here is that things are going to become expensive. They are not going to get any cheaper. what is 1 rupee today will definitely become 10 rupees tomorrow. So from an asset allocation point of view, so basically what is asset allocation? It is basically, in a simple language, you're diversifying all your assets, or you're diversifying all your investments into different baskets. You are putting some in real estate, you're putting some in equities, you're putting some in FDs, you're putting some in gold, and you're diversifying. The goal of an asset allocation should be your money has to be safe, it has to be liquidable. By liquidable, I mean to say that, again, let's say there is some emergency situation tomorrow and you need 1 crore of rupees. You should be able to liquidate your holdings, where you should be able to get that crore of rupees in the next 2-3 days. So are your investments liquidable? You need to, think for a minute here, that are your investments liquidable or they are not. And third is the rate of return. The right rate of return, the right rate of risk has to be taken to, to ensure that you reach to your goal in the best possible time, in your desired time frame. Now, I would like the participants to, participate with me in this one, please. Okay, so these are the here, there are examples of these 4 funds. If you look at all the funds, every fund has delivered a certain rate of return. If you look at fund 1, first 2 years amazing, third year has been a big drop, and then fourth year again amazing. Fund 2 been a first year good, second year not good, third year, fourth year great, and third and fourth. All these have a pattern. I would request all the participants to plug in their answer and tell me that which fund ideally you would have wanted to invest into here. Which would have been your fund pick if I were to present these funds to you and said that, okay, which fund would you like to invest in? Which fund would you have been the most comfortable to invest in? If people can write their responses in the chat, please. Sure. Till now I am seeing option 4. Okay, almost everybody is with option 4. Okay, last 10 seconds for your responses before I give out the answer. Okay, the answer is all the 4 funds have delivered the same return. I'll repeat, all the 4 funds have delivered the same return. But I can tell you for sure, the reason of you wanting to invest into fund 4 is because of the stability. You want to not have a fund which is, giving X return in year 1 and then negative return in year 2. So everybody here wants a very, very smooth ride. Is it possible at all points of time? The answer is no. But can you ensure that the volatility is reduced? The answer is yes. That is how you do it by an asset allocation approach. So once again, the answer here, all the funds have delivered the same return. That is the answer. Okay, one more question where I would want my audience to give an answer here, and I will explain you that I will try to link this with the earlier slide. So basically, there are a couple of these gentlemen, Dr. Ramesh Gupta, Dr. Pankaj Krishnan. Dr. Ramesh had the privilege of starting much early at 25 years of age, and he invested 25,000 rupees per month. And Dr. Pankaj started at age of 35. Either he did not have resources or he did not have the right advice, and he started at the age of 35, but he invested double the sum of amount of what Dr. Ramesh is doing. Who do you think will make more money? Will Dr. Ramesh make more money? Or do you think so Dr. Pankaj will make more money, assuming that they are investing for the next 20 years or so? Or rather, assuming that they both are investing for the same amount of time. What would be your answer? Okay, so somebody has taken a very, very safe option of calling both, but no, that's not the answer. That's not the answer. Okay, somebody has written Dr. Ramesh, Dr. Ramesh, Dr. Ramesh, Dr. Ramesh. Okay, fine. I see Dr. Ramesh as all the participants having till now having said Dr. Ramesh has made more money. Can somebody also elaborate that why do you think so Dr. Ramesh would have made more money? And why not Dr. Pankaj? Dr. Pankaj is investing double the sum. Yeah, can somebody please elaborate that why Dr. Ramesh? What's the reasoning of the okay? Compounding, okay. You are close, you're close. Okay, I'm very happy. I'm extremely happy with the answer. And everybody, all of you, except one, has got the answer right. Yes, it's Dr. Ramesh. So this is this is the real time. This is the real. This is the example. Sorry, this is the answer. Dr. Ramesh invested for 25 years. Dr. Pankaj invested for 15 years. The value what Dr. Ramesh got was 4.22 crores. Dr. Pankaj got 2.36 crore. Your answer is that compounding, but again, it is just not about the money you invest. It's about the time you remain invested. So friends, very important it is here that, we keep on saying that it is not about timing the market. It is about spending time in the market. So Dr. Ramesh started early and he let his money compound without disturbing it. And this is how he ended up with much bigger, or rather almost the double the sum of what Dr. Pankaj made, even though Dr. Pankaj had, invested, more amount. So I will take you back to the earlier slide where I had highlighted that I want to show you something where if you invest early, how is it advantageous? This is sorry, give me a minute. This is the slide which I was referring to, that unfortunately this is a disadvantage which you have where your startup phase or your earning phase starts pretty late. Now, since it is starting pretty late, it is very important that you invest more and more sum. Forget about the example which I gave you, but try to invest more and more sum. Try to stay invested for a longer time. Try to not disturb that money. Let it grow, and markets markets will deliver the kind of returns which where we give certain estimates, and that is how you can build the wealth. So I wanted to link it with this slide where though your startup phase is late, but you need to invest early. You need, given the opportunity, you should not delay, because if you delay, there is a cost. There is a big cost. Okay, so now having said that, whatever I said till now, that you need to diversify, you need to have an asset allocation approach. There needs to be a approach where you are making more than the inflation. Then what I am trying to get at, is that you should look at the vehicle called mutual fund to invest. You should look at mutual funds to to ensure that these this vehicle becomes the vehicle to reach your goal. Now, why do we talk about mutual fund? I'll just spend a minute here. That a mutual fund basically is a professionally managed fund. There is a professional fund manager looking into the day-to-day affairs of investing in stocks, where to enter, where to exit. It is very well diversified. I said that a diversification is very important. You cannot put all your eggs into one basket. You need to diversify. There is a return potential depending on where do you invest. An equity debt fund comes with a higher risk but comes with a higher return. There is a debt fund which comes with a lower risk but lower return, but it's very tax efficient. There is low cost because of the scale of investment. It's a low cost. There is liquidity. If you recall, I said that is your investment liquidable? If you were to invest into equity mutual funds, and if you were to give your redemption today, you would get the money after 3 days right into your bank account. If you were to invest into debt mutual funds, if you were to redeem, you will get it the next day itself. So are your investments liquidable? Which is again a very important role of asset allocation. Yes, they are very transparent in nature. You find all the information which is available. SIP is one vehicle where you can invest into mutual funds, and convenient administration. Some of you may be wondering that why am I talking about mutual fund? Why am I not talking about direct equity? See, direct equity is the highest form of risk one can take. You will need a lot of expertise. You are doctors. You may not have the time. You may not have the expertise to invest into direct equity. Therefore, it's very important that you let a professional fund manager do their job for you and try to deliver the kind of return what you expect. Just like I as an individual would come to a doctor if I am not ill. I cannot be my own doctor. I have to go a professional and I have to follow same way. The advice here is that to let your money to guide you on your money, you will need assistance of a financial planner. And at the end of the day, the financial planner will decide for you that where does your money need to go. Mutual funds, direct equity, real estate. He would do that asset allocation with you, with your permission, with your return expectation, and that is how it gets delivered. Also, a mutual fund offers option of an SIP, which few of us call the eighth wonder of the world. I will again repeat, we call SIP as the eighth wonder of the world because some of you mentioned in the previous example the power of compounding. SIP gives you a terrific power of compounding, which over the period of time helps you lower your investment costs so that you end up gaining a lot of money over the period of time. So let's quickly take a look at what is SIP. SIP is nothing but a fixed sum which you are investing at a periodic interval for a particular period. It is said that sometimes the most basic forms of investment or the most monotonous kind of investments make you the maximum return. The reason why we say this is that you can't time the market. Nobody can tell you that will the market go to 15,000 index on the Nifty or 25,000. They may get it right once, twice, but it's virtually impossible to guess where the market goes. SIP takes away all these biases of an individual. You are investing a fixed amount of money on a particular pre-decided date, and that is how that investment keeps on going on and on for 10 years, 15 years, 20 years, and you are at the end of the day rewarded handsomely. I will show in the next slides that what kind of SIP returns in the past the clients have made, what kind of returns can be expected going forward, and I'll give you a good example of also. But very simply speaking, the need of an SIP, it gives you discipline, which I just explained. It also facilitates planning for accumulation of corpus. Now, this is a very important point. When you are looking at reaching a goal or achieving a goal, what are you looking to do? You are looking to accumulate a corpus. If you would have that corpus, you want to use that corpus for a particular thing. It could either be marriage of your marriage of your kids. It could be opening up an hospital, a clinic, setting up of different hospitals across the states, country. So basically, this SIP approach will help you build that corpus so that you're able to fulfill your goal. And then the advantage is eliminating the need of timing the market. It takes away that bias. It gives you that discipline, cost averaging. Whether the market goes up, market goes down, you are averaging. When the markets are up, you are getting lower units, but when the markets are going down, you get higher units. And over a period of time, there is a good average which is developed. Benefits of power of compounding. As I said that you are compounding. Few of you gave the right answer also with Dr. Rajesh. So you already know what is compounding, and the compounding is best enjoyed via an SIP, and it inculcates a disciplined habit of saving. So basically, some of us as kids would have invested 5 rupees, 10 rupees in a piggy bank. We did not break that piggy bank for months or maybe years. And what happened? At the end of the time, at the end of the 1 year, we had a very, very lumpy or a very, very heavy box of that piggy bank, which we broke, and we could buy whatever we wanted. SIP is nothing but the same thing, just that in a piggy bank, your money is not compounding, but in an SIP, your money is compounding. So moving on, let's look at an example here. And I'll also relate this slide to the different kind of instruments which are available out there. First, let's look at it at a very, very simple way. That say, for example, you're investing 15,000 per month. what are the kind of what is the kind of money which one can expect to make. On the right hand side, we are giving you a rate of return. Sorry, please excuse me for a minute. So the rate of return here is 7%, 9%, 12 and 14. The time spans what we have taken is 5 years, 10 years, 15 years, 20 years. Let me just draw your attention to this 20 year. If your rate of return is say 12 or 14% at 20 years, let's first look at rate of return of say 14 years. 14% for 20 years. If you invest 15,000 per month, if you're invested for a period of 20 years, you are getting close to 1.97 crores. That is the estimate, that if the market gives you a rate of return of 14%. Same way, if you are invested for 20 years and the rate of return is 12%, your SIP would deliver 1.50, close to 1.50 CR. So this is what you can expect if you are doing an SIP of 15,000. Now at the end of the presentation, I would be showing you a financial calculator where you can plug in your own figures. You can do this math at your own end, either with your wives or either with your family, and see that what kind of an SIP should I set aside so that I am able to achieve my goal, which could be 5-year, 10-year, 15-year or 20-year down the lane. Now let's try to look at this slide from a different point of view. I would want you to put yourself into a situation where few of you would be very comfortable investing in a FD which has delivered say 7%. Let's take a scenario. Few of you would have invested into FDs 20 years back, which has delivered 7% return. So in that 20 years, you would have made 78 lakh rupees at the rate of return of 7%. Few of you would be comfortable investing into hybrid funds. What is hybrid fund? Hybrid is a combination of equity and debt. When I say debt, that is FD-like instrument, not same to FD, but it functions like an FD where your rate of return is estimated. So if those instruments delivered 9% rate of return, your corpus would have grown to 1 crore. And if somebody would have invested into equity, that equity would have delivered 14%. Your corpus would have grown to 1.97 crore. Now take a look at what then FD has done to you over 20 years, what equity has done to you for 14 years. The returns are double here, absolutely double. And this is why we get into equity. Higher returns, beating inflation, you are able to reach your goal faster. Is there a risk? Of course, I'm not saying the risk is not there, it is there, but there needs to be a portfolio approach. Now looking at this slide and giving you the 3 examples or the 3 avenues which are available, equity, debt and hybrid, we as a financial planner will allocate, looking at your risk profile, that where do you need to stay invested. We will give you equity options, we will give you debt options, we'll give you hybrid options. Say for example, somebody has an investment horizon for 20 years. We will tell them to take maximum risk into equity, because equity over a longer period of time has delivered fantastic returns, and it's still India is a growing country. It is one of the most sought after destinations. Still for the next 15-20 years, there will be enough opportunities on the equity side. Because what happens is that if you invest into a FD at 7%, and if your inflation is at 6 to 7%, you are not making any money to beat that inflation. In fact, you are starting to get into a zone where either you will not reach your goals, or either the things will become so expensive that you will not be able to afford them. That is also a prime reason of why you should be into equity. So this slide beautifully shows that when you are investing into different kind of instruments, what kind of returns one can make. Over a shorter period of time, let's say a 5-year, at 7%, 10 lakhs, and a 14%, 13 lakhs, you may say कि चलो 3 बरस 3 लाख का ही फर्क है, लेकिन risk नहीं लिया. But that return balloons, or it completely goes out of proportion when it is 20 years. So you are doing a big value destruction by just staying invested into an FD kind of a product, which is a very, very big risk to have. So this is what the slide is. This is the power of compounding, and this is how the power of compounding actually works. We'll take this example at the end when we'll do live calculations on those on that financial calculator, which will be giving it to you for your personal use, and you can actually plan your finances better with that. Now coming to power of passive income, what we are trying to say here is that when you invest wisely, when you invest properly, you are working hard for your money in your medical profession, but your money is also working harder for you. So basically, the whole idea here is that you should have alternate sources of income. So here, what we try to say is investment. We are not saying that outside of your practice you should do something. Here, we are purely and purely limiting ourselves and saying that you need to invest wisely. You need to invest in a manner where it is becoming a passive income for you. Second is, due to your time constraints, it's best to have a financial advisor who is trustworthy and gives you quality advice. You should definitely meet a financial advisor or let the right financial advisor who understands you make the decisions for you, because you're too busy managing your money. Third is, working hard is not an alternative. You need to work smart. When you invest, you are not trying to work hard, but you're trying to make smart choices, which over a longer period of time tends to give you the right, gives you the kind of money which you're looking to build. That is what it tries to say. And fourth is, take care of your investments and it'll take care of you. जो money आप आज invest करोगे, that will take care of you in the future. And that is what we're trying to say. I will show you a beautiful audio visual. It's quite an old audio visual, but it will exactly try to tell you that what you need to do. After the audio visual, I once again invite everybody to write in the chat box that what is that audio visual trying to say.
Camry is an English learning app. Camry app.
Yeah, is everybody able to see the YouTube which has opened up? Ayushi, if you can please confirm.
Rachit and Dr. Reddy here. I'm not able to.
Okay, fine. So I'll have to share screen. 1 minute. Okay, now you should be able to see, right?
Yes, yes, yes.
काम करें और आपका पैसा आएगा, क्या ही सही है। और आप बिरला सन लाइफ म्यूचुअल फंड में निवेश करें, आप रिटर्न्स कमाएं। बिरला सन लाइफ म्यूचुअल फंड, द नेम इज फास्ट ट्रस्ट.
Okay, I just realized that there was no audio to it, but I'll tell you what it was. The gentleman sitting there was able to hear certain sounds. He was not able to figure out that what are those sounds. So he could hear a snoring sound, and that's when he went to that vault, and he saw that his money is sleeping there and snoring. My question to all the participants is that what is that ad, or what is Birla Sun Life, who has been the creator of the ad, trying to say? Please, if I can have your responses in the chat box. I'll once again repeat, the ad basically showed that there is certain sound which the gentleman was able to hear. He was checking that, why is that snoring sound coming and from where is it coming? Okay. 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 Some three responses. Very good responses. Okay. 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 I'm very glad with the answer. Some of you have got it absolutely right. That the money is lying in the bank account. It is snoring and not working hard for you. I have repeatedly said in my presentation that you have to ensure that the money works harder. The money works harder than you. So in this ad, it is saying that if you are going to keep all your money in the locker or the vault, it is not going to work for you. Your money is supposed to be working harder for you, harder than you. We got this slide, we got this AV, and we said that it's a very beautiful way of saying that you need to invest your money in the right instruments so that it works harder for you. You're able to achieve your goals and you're able to live a very good and successful life. That is what it is. Very happy with the responses. Some of you have absolutely got it bang on. So moving on. Okay, so I'm just about to reach the final stages of the presentations. To sum up, what are some of the mistakes which a lot of the individuals do? Take an example that which car do you use? Some of you might be using a Maruti, Hyundai, Skoda, maybe Mercs, maybe BMWs. But why don't you use a Fiat or an Ambassador, which are parents or grandparents used and they were proudly using, and they are, even if today given a choice, they might either go for a Fiat or an Ambassador. Same way, you might be wearing watches. Somebody might be wearing a Titan, some Omega, Fossil, Seiko. Hello. Hello.
Yes, you are audible, Mr. Rachit.
Okay. No, I heard some voice. Yeah. Hello. Can I go on?
Yeah.
Okay.
We all are muted, Mr. Rachit, so don't worry.
Okay. Fine. So, okay. So basically, where do you basically invest? Many of you would be investing in post office, LIC, recurring deposits, plots of land. Okay. So sorry, just give me a minute.
What we would be doing is a very interesting thing called income taxes.
Sorry. There is an audio at my end which I need to shut off. I'm sorry. The YouTube was playing at my end. Sorry. My screen is up, right?
Yes.
Okay. So what we are trying to say here is,
Rachit, your PPT is not up. It's just the video.
Okay. Sorry for that.
No problem.
Okay, now it should be up. Okay, so what we are trying to say here is that, many of you have moved on to expensive cars, better cars, buying better watches, maybe buying better, outfits for yourself, not going to the old brands. But still, many of you are still comfortable with the LICs, post offices, FDs, and not looking at equity mutual funds, not looking at PMS, portfolio management, not looking at startups, not looking at private equity. So we need to move ahead with time. Just like, we have moved on to the expensive and luxurious side of goods. Same way your investment habits have to change, and you need to upgrade to, the modern ways of investing. And finally, food for thought. You need to start ASAP. Less is fine, but it's never too late. Compounding magic is a factor of time invested, which we already saw. regularly update your knowledge, keep reading. It's going to be boring at first, but trust me, the more and more you read about finance, the more and more interesting it gets. Of course, you would have a financial planner by your side where who's always going to keep you updated and discuss your matters with you. Pay regular taxes. As I said, I highlighted that it's important that you route your money through bank account, because when you route your money through bank account, that's when a lot of investable opportunities open up to you. And it gives you peace also. Your money is in the right instruments, and you are the rightful owner of the money. So it also helps you to earn a higher rate of return, and it works harder for you. Money in the bank account is nothing but a sleeping money. And this is an interesting slide. When you are investing into equities, when you are investing into direct stocks, or whether you are investing into PMS, you are becoming the partners. You are buying stocks of these companies, either directly, indirectly. So you're becoming the partners. All these gentlemen are known to create tremendous wealth for themselves and for the shareholders. So the message I'm trying to give here is, be their partners, trust your money with them, and see how your money compounds. A very good quote. If investing is entertaining, if you're having fun, you're probably not making any money. Good investing is boring. When I say good investing is boring, take the route of an SIP. Some of you might be doing direct stocks, maybe experiencing daily euphoria. Someday paisa bana, someday paisa nahi bana. That might be giving you some kind of a rush. But the best form of investing is investing systematically, investing regularly, which is the best form of investment. Said by a very accomplished investor called Mr. George Soros. And thank you very much once again for giving us this opportunity, spending close to an hour with us. And I'm leaving behind the contact details of Mr. Pratik Trivedi, who is my colleague at Sapient. He is the one who did this basically arranged this presentation in association with WhiteCoats. These are his contact details in case you need to get in touch with him for any portfolio review, financial guidance. Also, the calculator which I'm going to showcase now, you can get in touch with him, and he will be more than happy to share the calculator with you. With this, I am more than happy to first take any questions and then showcase the financial calculator, or whatever way you would like to for us to go ahead. So, Dr. Reddy and Ayushi, if you could please take over and guide us.
Rachit, I think we'll do one question and then probably look at the calculator, and then we can go on with the rest of the flow of questions. Sure. This is personally from me on behalf of a lot of doctors from my own community. Like I said, financial literacy and what you just showcased, it's not something we are trained in or we understand better. We all pick up on the go as we move forward in life. And like you rightly showcased, we start late in terms of earning as well, because of our education system, the way it is, scheduled. It takes a longer time to start making money in medical profession, number one. Two, we might have started investing late also for that reason. Some of us may not have started investing, or whatever it is, right? Now, what you've showcased is an ideal scenario, what we should be doing and how we can make the best out of it, right? Before we go into any actual questions from the doctors that have come in, let's take an example of someone who's not done it right at all, and who's probably done, bad investment, or who's not gone by the book, who did not know how to invest, who didn't know Rachit, let's say. And if that person is attending the session today, how do they begin cleaning up the finances? How do they begin this journey? Where do they start? How do they start? Where does it begin from?
Okay, a very relevant question. So the first point is, the starting point here is that you need to get in touch with the financial advisor. So let's take a scenario here that since we are financial advisors, somebody approaches us, say, somebody from this group approaches us. First thing what we would advise you is that we would like to look at everything what you would have. So, like we say that never hide your, your truth from a doctors and lawyers. Same way we would say that never hide your finances or anything what you hold from your financial advisor. We need to take a view of where has been your money lying, because from there we need to assess that which is that asset class where you are exposed to. somebody who wants to invest for a 15 to 20 years and having their money in debt or FDs would be doing a big value destruction, which I already showed. Or somebody who is very close to the goal, say after 3 years, they would need a significant chunk of money, should not ideally be into equity. So these are the decisions what we need to make, or show our clients that, this is how, your wealth is. This is how you need to plan your wealth. And any wealth, any financial planning is incomplete without we asking a lot of questions to clients. The questions could be, what are your goals? Your goals could be different. Everybody's goal could be different. So a financial plan for everybody is very different. Somebody may want to have money at the end of 5 years, somebody at 15 years, somebody at 20 years. Their risk-taking ability would be very different. Some people may already have a lot of wealth. So even though their risk appetite is very high, we may advise that you don't need to take these kind of risks. Somebody who may not have enough money but wants to take a lot of risk, that risk can be advised if the investment horizon is longer. So the first, again, summing up, the first point is meet a financial advisor, showcase all your investments to him or her, and and let the person consolidate everything for you. What we call here is a portfolio review. So anything starts with a portfolio review, and from there on, the financial advisor would then handhold you and tell you that, how do you need to plan your finances.
Fair enough, Rachit. I'm picking up a question from the chat box, which has now come up, and I would like to add it to what we've just tried addressing, right? A lot of us spend enough time in our lives repaying loans, building assets, right? And not essentially in the financial instruments that you spoke about, right? Societal norms, the traditional investment mechanisms that we are used to, we are taught, right? Now, there's a question in the chat box in similar lines, right? Most of my adulthood and earning years have gone into building the assets, paying the loans, or, procuring assets, right? And maybe the person is asking that I have not spent enough time in researching about these kinds of investments you're talking about, and I have not invested so much. Now, Rachit, could you throw some light on somebody like that at a later stage of career who has less window, but would have considerably accumulated some wealth, some assets, right? How do they look at this? Do they liquidate that? How do they do that?
Okay, so see, basically, yes, this is again a typical issue what we have seen in our financial planning journey of all these years, that some people have a lot of outgoes, but they do not have enough to invest. Or some people who had very heavy outgoes, they had little to invest, but they invested at the wrong, they invested into the wrong instruments, or they just invested on the advice of their family members, and unfortunately, those investments were not enough to cover them for the later years. So again, in this situation, what we will need to do is, work very closely with the client to see that what kind of money is available, what money is there for the outgo, till what time is the person expected to make money, when does he want to retire. And I'll tell you one thing, that financial calculator which we are going to showcase will give you all these answers, because very randomly somebody may want to retire at the age of 55, but when we do the entire financial planning in a 360 manner, the answer could come up is that, unfortunately, looking at the current state of affairs, you may not be able to retire at the age of 55. You may have to retire at the age of 60. Because another crucial question which we ask people is that, till what age do you expect to live? So, we take as 80 as a, life expectancy. Now, why do we ask these questions? There are two very big risks in life. Either either a person passes away too early or passes away too late. If he passes away too early and if he doesn't have enough insurance, the family members are in trouble. And if he passes away too late, but if he has not invested enough money, then he may unfortunately not have enough money at the time of retirement, and he may actually die poor. These are, couple of scenarios which we see very, very closely on almost day-to-day basis. So again, we need to do that financial review. Since we are financial advisors, since we are very, very client-centric, we look at all these aspects very carefully, because one person's case would be very different from the another one. I hope I have been able to answer the
Yes,
question.
yes. Thanks for that, Rachit. Let's go on to the calculator and then we'll come back to more questions so that it keeps the audience engaged.
Sure, sure.
All right.
So for this calculator, I'll require somebody to be, to be a live case so that, we can try to relate to that person's situation. And I'm sure it will be very interactive. So I welcome anybody who would like to, be a volunteer for this.
Yeah, Mr. Rachit, one person has raised his hand, so I'll allow him to talk so that
Okay, sure.
just give me a moment.
I hope everybody is able to see the calculator.
Yes, yes.
Mr. Gautam, you can unmute yourself and now you can interact with Mr. Rachit.
At the age of 70, I have enough investments which are over the years into issues when they got launched. I have not done much trading in shares. But how do I look to a secure future now that I may have to give up my clinic
So,
and retire?
sure. So, Mr. Gautam, if you don't mind, I will answer this question post this, post the display of this calculator. Would you like to volunteer for this calculator, or you would want me to answer that a little later after this?
You can answer that a little later. No problem, sir.
Okay. Okay. Thank you. Thank you so much. So, Ayushi, would you like to invite somebody, or would you like to do this yourself?
Yeah, first, if we will ask anybody who's interested, they can interact and volunteer this.
Sure.
Rachit,
Anybody would like to volunteer, please?
Rachit, I see a student, I think Dr. Tanaya has put in the chat box saying that I'm still a student. How should I invest in SIP? Would she be an ideal person here? Should we invite her?
Absolutely, absolutely. She would be the most ideal person. Yeah.
Okay, Dr. Tanaya, would you like to join us in the conversation so that we will try and do this calculation? Dr. Tanaya? Ayushi, can you aid this?
Yeah, I'm just searching her name.
Sure.
Yeah, Dr. Tanaya, now you can unmute yourself.
Hello.
Hi, Dr. Tanaya.
Hi, Dr. Tanaya.
Yeah, hi. Good evening, doctor. Are we ready to go ahead with this?
Yeah, okay.
Okay,
Alright.
I'll ask you a few questions. If you can only give me the answers, I'll keep on plugging the figures and I'll explain you what I'm doing.
Yeah, okay.
Okay, since you mentioned you are a doctor, since you mentioned you are still studying, let's assume a monthly SIP amount which you would like to set aside. If you have something in mind, you can put it here, or it can also be an hypothetical amount here.
Okay.
The
Since I'm still studying, I will just put some. What I can do right now is 2,000 or 3,000 per month.
Okay, let's take an example of 3,000 per month. Okay, so the number of years. So now, since you are studying, and let me assume that you would have at least next 30-35 years of active practice. Can we put this number of years as 30 years?
Yeah, I'm 24 right now. So like, yeah, okay, 35. Okay, 30 years, fine.
Okay, let's have it 30. Okay. Now the other thing is what year it is that you are not going to keep your amount at 30,000 only.
Yeah.
As you actively practice, as you keep on practicing more and more, the more and more engaged you get, you would also be increasing your SIP amounts, or you would be in the position to increase your SIPs. So
Yes.
can we put this figure at 6%, 7 or 8%? That is the annual increase which you will keep on doing.
Okay.
So would you like it to be a 6% or 7 or 8? I would want you to make the choice.
Maybe 8%.
Okay, so you will increase your SIPs by 8% every year. And now, since we are looking at equity investment, looking that this money is going to go into equities, let's have a conservative rate of return of 12%. Okay.
Okay.
So now if you follow this pattern, that you have 3,000 rupees per month to invest, 30 years, annual increment of 8%, 12% is the return expectation. At the end of 30 years, 1 crore 90 lakhs is what you would accumulate for yourself.
Okay.
Okay. Now, if you see on the right hand side, it says it says that at 22 you are starting your investment from 1st April 22, and your end date is going to be in 2052.
Okay.
Now we will go a little down, we'll slide a little below. Here, what it says is that after assuming that after the age of after finishing 30 years, this is your retirement period. Now, at retirement, you may not want to take a risk of 12%. You may say that now I have made enough corpus. I want to now, enjoy this money and put it into an instrument which is, let's say, risk-free, or which is having little bit of risk. What kind of a person are you? Would you still want to take little bit of risk, or would you like to put it into an instrument which is completely risk-free?
I would like to take a little risk.
Okay, so can we say 9% is good?
Okay, yeah, 9%. Let's go with that.
Okay, so I have put in 9%. Now, what is the next expected monthly withdrawal amount? See, you can see a figure of 175, and just right next to that, there is a gray cell which is 27,345. So all participants, what this is this 27,345 is the amount which is the monthly expense today. So, doctor, what kind of a monthly expense do you incur today?
Monthly expense, my monthly expense.
Yeah.
10,000.
Okay, so okay. One second. Just give me a minute. Okay, sorry, there is some problem. Let me just sort out, but I'll explain you what this is. Just give me a minute.
Okay.
Okay, now coming back to this. Now, since you said you have an expense of 10,000 per month, I am going to just put a one figure here. Okay, that's close to, okay, still higher. Okay, so what this says is that, the 10,000 rupees expense, what you are doing today, in 2052, that expense will grow to 65,000. Why will it grow to 65,000? Because of inflation.
Yeah.
The assumption of, so, here highlighted here, we have taken an assumption of 6%. So, if I can ask you that, can we base your, right from the time when you will stop investing, after that time, how many more years of investment would you like to, how many more, for how much more you would like your planning to be for how many years? Can we say 25 years or 20 years or 15 years? What do you think?
15 years.
Okay, 15 years. So now an annual increase, now we are again giving an option that what if you increase your withdrawals by 6%? Okay. So what I am saying here is that 65,000 rupees, your 10,000 today will become 65,000 then, and your annual expense will grow by 6%. So what we are making a plan for you that for the next 15 years, you will have enough money to keep on spending this kind of money and also an increment. Okay.
Okay. Yeah.
Now here, what does it say? Will the withdrawal continue till the end of 15 years? The answer is yes. It will. if you maintain this lifestyle, you will keep on you will keep on having this kind of money with you without any issues. And at the end of 15 years, still after withdrawing this kind of money, you will have a corpus of 3 crore and 54 lakh rupees.
Okay.
Okay. So you are absolutely fine. If you were to follow this kind of a pattern, you would be absolutely fine.
Okay. But my expenses may increase because
so
I'm still studying. So obviously my expenses are limited. So it may increase.
Absolutely a valid point. So basically, this calculator will try to account for everything here. Now, let me take another scenario. Say, for example, after 2 years or after 3 years, you are in the position to invest 15,000 per month. Okay.
Okay.
Just remember this figure: when you are investing 3,000 rupees for 30 years, growing at 12% and increasing by 8% annually, you are making 1 crore 90 lakhs at the end of 30 years. Now, what happens if I put this 15,000? See the massive increase in the total corpus.
Yeah.
So the bottom line here is what we visited in the slides, that the number of years you are investing makes a lot of difference. That is in your control.
Okay.
If this rate of return, if I just increase by say 1%, see the kind of increment, 2 crores.
Okay.
Just by 1% rate of return. The difference here is because of the compounding. Your money is compounding. And now the shocking figure, what you would like to see down is here. At the end of 15 years, you are going to leave behind 37 crores.
Okay.
Okay. And now let's say that, your 65,000, you say that you are going to withdraw say 2 lakh rupees a month. Or you would like to plan for 2 lakh rupees a month. Even after spending 2 lakh rupees a month, still your positive balance is 30 crores.
Okay. Yeah.
So, doctor, all I'm trying to say is that people need to plan early. If they are not in the position to start early, they need to invest more and more later. Let it compound for more and more years. And when it is time to withdraw, keep it into an instrument where they were comfortable. If they have made a lot of money in equity, that can definitely be transferred, and they can definitely be transferred into an instrument with less risk. And I have not shown these sheets. These are different sheets where we do complex financial planning. Say, for example, you say that after 10 years, I want to withdraw some money for an expensive car. Fine, we'll put it up accordingly. After withdrawal phase, you may say that I want to give away, say, 5 crore rupees into charity. Is it possible or not? We'll plug the figures here and we'll do that for you. We are also showing here that, after 30 years, what kind of money withdrawal you will be making. So it's a very, very complex sheet, very, very well designed sheet from our end, where our financial advisor will sit with you and plan basis this. So whatever we are doing has basis, whatever we are doing has certain projections. So this is why this sheet we are going to share with you, so you can do your own planning. But since financial planning is a complex subject, my request to you is that you should get in touch with Pratik Trivedi. Pratik Trivedi will take you through the entire thing, will review your portfolio, will give you projections, and will be with you in this journey, hand-holding you in this journey of planning well, so that you are able to reach your goals faster, or you are able to enjoy your retirement and leave behind the money what you always wanted. So this was the purpose of the financial calculator. Any questions you have, doctor?
No, as such, I don't have any right now.
Okay. Thank you so much for volunteering, and I hope you found the presentation and the tool useful.
Yes, thank you so much. It was very useful for me.
Thank you.
Thank you, Dr. Tanaya. Should we go back to, I think there was one question by Dr. Gautam Rachit.
Yeah. Just one second, please. Yeah, Dr. Gautam. Is he unmuted?
I guess so. Ayushi?
Yeah, I have muted him again. 1 second.
Yeah.
Yeah, he's unmuted now. Mr. Gautam, please unmute yourself. Yeah.
Yeah, I have unmuted. Yeah.
Yeah, Dr. Gautam, I'll just sum up the question if I've understood it right. You're saying that you have accumulated wealth and you have the accumulation, you are pretty happy with the kind of wealth which you have, and what do you need to do next? Have I got the question right?
Yeah, partly. Now, what I intend is, suppose I have to retire. Okay.
Okay.
I'm 73. Suppose I retire next year. Let's say I retire next year. The only solid asset that I have is my clinic.
Okay.
It's a commercial shop which I'm using as a clinic.
Okay.
Its value would be, on a rough estimate, about 1.85 crores.
Okay.
How should I plan my investments?
Okay, so I'll give you a, very brief answer in this, because as I said, we will need to sit with you and understand, but I'll tell you the approach what we would follow. And I shared this earlier also. We will first will look at all the liquidable investments you would have. When I say liquidable investments, all we are trying to ascertain is the liquidity, because when you retire, you would need those assets. Are they giving you dividends? Are they giving you appreciation? We need to classify that accordingly. We'll have to estimate that what kind of a retirement monthly income you would need, since these assets are going to be a replaceable income. Or what assets are you holding on the fixed side, which is the real estate which you just shared. First and foremost stage will again be here the portfolio review, understanding your goals, understanding your life expectancy, and how do we need to take risk? Do we not need to take risk? If you ask me very, very simply, at your age, I would suggest you not to take risk by investing. But if you say that my investment horizon is 10 years, 15 years, then yes, there is some scope of risk. So it will be very, very personalized, but this is how we'll follow everything, understanding the 360-degree of the client and going ahead with that.
I appreciate that.
I hope I have answered. Is there anything else you would like?
No, is it better to go in for an annuity scheme, which gives, say, about 15% return?
Sorry, your voice cracked a between. I did not catch it. If you can please repeat.
Would it be worthwhile investing in an annuity scheme which gives a return of about 15% annually? Okay, guaranteed, so 15% annually.
Okay, so you mean to say annuity would be the insurance, right? The vehicle would be insurance, right?
Not insurance. There are certain banks that give annuity schemes which offer a guaranteed 15% return.
So very honestly, 15% looks too good to believe. I will need to see the fine prints. I will need to see, if you ask me very, very broadly without looking at your portfolio, 15% is extremely good. One should go ahead. But when I portfolio review, when I see the fine print, at that time, I'll be able to give you a concrete review, a concrete answer.
Very true. Let us take a conservative estimate. Let us say it is 12%.
Yeah. No, so as I said, anything in excess of 10-11% sounds great. But, as I said, now that I showed this calculator also, we need to plug in figures and all. On the face of it, yes. But after looking at your entire portfolio and all, a concrete answer can be given at all.
I understand. Thank you so much.
Thank you, sir.
All right, Rachit, let's pick up some more questions that have come in from the audience. I think one question in the lines of the same conversation we were having, right, which was repeatedly asked by doctors that have come into us, is how does a doctor plan for retirement planning or a safer, planning for the old age? Any brief that you would like to give, or?
Yeah. So if possible, number one, if possible, start early as possible. I would say Dr. Tanya, who did, who volunteered, from her side, in case she wouldn't have seen this presentation earlier, she would have not, if she wouldn't have seen the presentation today, she would have not realized the importance of starting early. Maybe consciously what she will now do is try to set aside some of the other money so that she can start early and enjoy the power of compounding. Same way for people who do not have too much time by their side, the request to them would be to invest more and more, invest into equities if the horizon is more than 5 years, 6 years. because that is one asset class which can deliver returns which are beating inflation very, very comfortably. And three, that since I've highlighted the problem of FDs over a longer period of time, I'm not saying that you should not have FDs, but you need to have FDs based on, your financial plan. So a right approach is go ahead with a financial planning approach, go in for an asset allocation approach. I'm not saying that you should only do it with Sapient. You can do it with anybody, but a financial planning approach, asset allocation approach, not being in love with only one asset class. Need to diversify, need to have gold, need to have equity, need to have insurance, but again, insurance from a covering your family point of view, and everybody will be good.
Okay, great. I think rest a lot of questions that have come in, you've addressed during your presentation. A lot of them have asked about, how much to invest to be able to withdraw a certain sum, and some questions similar to that. I think those have been addressed in the PPT, so I'm not repeating them. This is a request to the audience. We're going to close the session in a while. So if there are any last questions that anybody wants to ask, go ahead. We've got 5 more minutes, I would say.
Sure. And also I'll once again make an appeal, and Dr. Pratik will be in touch with you. Anybody wanting this tool, we are more than happy to share. They can try the tool at their end. Pratik is there to give a demo over Zoom, one-on-one meeting. We are always available.
Sure, I think that would be great. I think, like you rightly said, this is an eye opener, and a lot of kind of an awareness session for a lot of us who've probably not heard all of it together like this. We might have heard pieces of it. So I'm sure there would be a lot of others like Dr. Tanya who would want to kind of, see where this can take them. So we'll put them in touch with you. Ayushi, if there are no more questions, then could you please do the closing remarks, or are there any questions?
No, Dr. Shravani, for now, we don't have any questions anymore. So I think we should wrap it up then.
All right. Personally, from the side of WhiteCoats and from the side of community of doctors, that's my own community as well, I'd like to personally thank Sapient and Mr. Rachit and Pratik. This was a very, very informative and insightful session, and not many of us get the opportunities to learn like this and get coached like this. So now we see the need for, investing right, where, how, and probably the need to have a coach with us to kind of guide us through that journey, and why is that important. A lot of times we are wary and worried about doing investments in these lines is because we don't have enough knowledge. That's the reason we end up, a lot of us end up investing in, traditional investment methods. I think you've showcased this wonderfully. Wealth management is not something that all of us pick up naturally. So we are glad that we are part of this session. So thank you very much. It was very informative. And any doctor, this is to the doctors who attended, thank you very much for your time. Please kindly look forward to the posting of the recording of this session also on our app. And when that happens, my personal request is please kindly share it across your networks. And to Sapient, if there's any incoming requests or queries from our community of doctors, we'd be happy to forward it to you so that you can take them forward. Thank you so much for your time. I had a great time attending this. Thank you
so much. And we would also like to extend our thanks for giving us this opportunity. And we are hopeful that we have been able to add value. And once again, thank you very much for your service. And you guys were our warriors and our saviors during the COVID times. And God bless all the doctors. So we are in safe and sound health. Thank you.
Thank you so much. And we hope our money is safe with people like you as well. And that's what we hope to see. Thank you very much. And thanks everyone, doctors, for attending. We'll catch you on another interesting session very soon. I see it in the chat box. A lot of you are writing about recording. That will be posted. Please kindly look it up in the WhiteCoats app or the YouTube channel or the social media handles. We'll get it up there, at least if not late by tomorrow. Thank you so much, everyone. Good evening and have a lovely weekend. Bye-bye.
Thank you.
Bye. Bye.
Bye.
Thank you. Have a great day. Bye.
Thank you. Bye.